Fortuna Silver Mines is generally regarded by industry experts as one of the better mid-tier precious metal miners. The company has had a big run-up in their stock price lately, so today we're going to dig into the company to see if it's still a good value, whether their debt's a problem, how much money they could possibly be making this year, and also what kind of stock price we might expect in the future. And the company trades on the New York Stock Exchange under the ticker FSM, and right now it's trading for $4.51 per share. First, I want to go over some things that I like about the company. Number one is their proven management team. This management team has been at this for a long time, and over those many years, they've proven to be successful mine builders and also pretty smart capital allocators. And they've grown the business from having one very small mine to being a respectable mid-sized producer. Something else I like about the company is that their cash flows are pretty diversified. They have 5 different mines in 5 different countries around the world. And also their best mine is their Séguéla mine that they just built in Côte d'Ivoire. And they have lots and lots of exploration upside at that mine. So the reserves there are likely to grow a lot, and probably in the future they expand that mine to be producing at a higher rate than what it's producing at today. And something else I like is that 2024 is going to be the first full year of production from the Séguéla mine. Record production levels should be set in 2024 for the company. A few years back, Fortuna acquired a company operating in Africa called Roxgold. They had 1 operating mine and 1 development project. And since they bought Roxgold, they've had incredible results in Africa. First, that Yaramoko mine that Roxgold had producing, well, that was set for closure in 2023. But Fortuna has been able to find a lot more ounces there and drop the operating cost by quite a bit. So in just a couple of years, Fortuna has converted that from a mine that was set for closure in 2023 and was making almost no money at all, and today is making a lot of money and is now set for closure in 2026. So they keep expanding that and they keep reducing the cost, which has been really great. But also that Séguéla mine, they built it on time and on budget, and now it's a cash cow for the company with tons of exploration upside. So you had this Latin American management team. The CEO is from Peru. He speaks Spanish and English. And there was a lot of questions about whether they would be able to operate well in Africa, because before that, they had been in the Americas the whole time. They had a mine in Mexico, in Peru, and in Argentina. So they were expanding to Africa, and investors were nervous about that. But clearly, they've showed the market that yes, they can operate very efficiently in Africa. And now for some things I don't love about the company. Number one is that 2 out of their 5 mines are set for closure pretty soon. Their San Jose mine in Oaxaca, Mexico is set for closure in 2024. And number 2, their Yaramoko mine in Burkina Faso is set for closure in 2026. And the fact that those 2 mines are set for closure means we could see a decreasing production profile in the coming years if the company doesn't invest in additional growth projects. And speaking of a lower production profile, it looks like we're going to go from producing about 480,000 ounces in 2024 to only about 400,000 ounces in 2025, unless the company can extend that mine life in Oaxaca and perhaps have some improvements at some of the other mines to increase the production elsewhere. Something else that's a risk is that the company's all-in sustaining costs are pretty high. Now, they're not way up there, but they are higher than average. Something else I don't love is that the executive salaries are pretty high, as is the general and administrative expenses. And I'll get more into that in a little bit here, and I'll show you what I mean. Something else I don't love is that there's no near-term growth projects. They have an advanced exploration project in Senegal called their Diamba Sud project, and that best case scenario is in production 3 years from now. And also their Séguéla mine in Côte d'Ivoire could be expanded, but expanding that is probably a 3-year project as well. So I don't see any big additional growth within the next 3 years. And also the company has pretty high political risk. So they have a mine in Mexico that had been a total nightmare for them. They have a mine in Argentina, which isn't the best place either. And then they have one in Burkina Faso, which has major safety issues, and there was just a coup there. And then they have one in Peru, and Peru seems to change their president about once a year and has been pretty unstable lately. So although they're diversified across 5 different producing mines, 4 of those 5 are in places that I would consider pretty risky. I mentioned that the executive salaries are pretty high, so let's take a look at those now. You have Jorge Ganoza, the CEO. He had a salary of almost $3.5 million. And then you have Luis Ganoza, who I believe is Jorge's brother. He's a CFO, and his salary is $1.73 million. And then you have 3 other executives here whose salaries are all above $1 million. And comparing these salaries relative to the salaries of companies of similar size, well, in my experience, these are pretty high. Now, for clarity, I'm not against paying company executives a very, very healthy salary if they deliver outstanding results. And although Fortuna Silver has overall, I think, produced good results, I don't think they've produced good enough results to deserve these kind of salaries, at least not yet. And I would like to see the CEO of a company own 5 times their annual salary in shares. And Jorge Ganoza currently has about 2 million shares, which, thanks to a big run-up in price the last few days, are worth about $9 million, or about 2.5 times his salary. So personally, I don't think that the CEO owns enough shares relative to his salary. And why is it that I want the CEO to have 5 times his annual salary in shares? Well, that's to ensure that he's working for us, the shareholders, and not for himself. Because if the CEO owns lots and lots of shares based on his own self-interest, the thing he's going to care about the most is the performance of the company and the performance of the share price. And on the other hand, if the CEO doesn't own any shares, well, that person's biggest concern is not the performance of the company or the performance of the share price. That CEO's biggest concern would be to make sure they continue getting paid their salary. Now, I'm not saying that Jorge doesn't have the shareholders' best interest in mind. I'm just saying that I would like him to own more shares than he does. And now let's look at recent insider buying and selling to see what insiders are doing with the shares that they hold. So we can see here that throughout 2023, there was some insider buying going on. But as we got towards the end of 2023, it turned into insider selling. As a matter of fact, the CEO, Jorge Ganoza, sold 500,000 shares towards the end of the year, and Luis Ganoza sold 160,000 shares. It's not uncommon to see executives sell shares because part of their salary is paid in shares, and they don't always want to maintain that big of an exposure to the company. Looking at the insider buying and selling here, I don't see it as a negative, but I don't see it as a positive either. I see this as pretty neutral. I also mentioned that Fortuna's general and administrative expenses are pretty high. So what I want to do is compare them to some other companies. So here I have Fortuna Silver Mines, I have B2 Gold, Equinox, and Alamos Gold. Fortuna's G&A is $64.1 million, B2 Gold 67.6, Equinox 46.2, and Alamos 27.6. You might think that this doesn't look too bad comparing it to B2 Gold. However, B2 Gold is a significantly larger company. As a matter of fact, all 3 of these companies are larger companies than Fortuna Silver Mines, but Fortuna Silver Mines is almost the same as BTG and significantly higher than Equinox and Alamos. But this G&A comparison gets really interesting when you compare their G&A as a percentage of market cap, a percentage of revenue, and a percentage of gross profit. Fortuna's G&A expense as a percentage of market cap is 5.5%. Compare that to their well-run competitors. B2 Gold is 2%, Equinox 2.3%, and Fortuna is 11 times worse than Alamos at 0.5%. Fortuna's G&A as a percentage of revenue is 7.6%. Compared to B2 Gold, it's more than twice as bad. Compared to Equinox, it's about twice as bad. And compared to Alamos, Fortuna's numbers are 3 times worse. And when thinking about general and administrative expenses, the higher the G&A, the bigger the hurdle to profitability. So the higher your G&A, the higher the gold price needs to be profitable. And now the G&A as a percentage of gross profit. Fortuna comes in at a whopping 33.7%. Equinox isn't great here either because Equinox has pretty high cost mines, but still Equinox is less than half of Fortuna. And comparing it to B2 Gold or Alamos, these numbers are not even close. This number is like 6 times higher than B2 Gold's and 7 times higher than Alamos. So I think this G&A comparison as a percentage of market cap, revenue, and gross profit to some well-run competitors really shows just how high Fortuna's general and administrative expenses are. And now let's talk about the company's debt. Right now, they have $140 million drawn on their credit facility, which carries an annual interest rate of 7.84%. And also they have a $45.7 million convertible debenture, which has an interest rate of 4.65%. And this convertible debenture matures in October 2024, and it's convertible at $5 a share. So the current stock price is getting pretty close to where this is convertible at. So if we exceed $5 a share, well then this will probably be converted to shares, in which case that would add 9.14 million shares to the share registry, which would equal about a 3% increase in the number of shares outstanding. But if the stock price is below $5, this probably will not be converted into shares, in which case Fortuna would owe them that $45.7 million at the end of October. That leaves the company's debt balance at about $186 million. However, they're paying it down really fast. In quarter 3 of 2023, they paid $40 million. In quarter 4 of 2023, they paid $41 million. And in February of this year, they paid $25 million. So ever since their Séguéla mine got into production, they've been generating a lot of cash and have been able to pay this down really quickly. And since then, the gold prices have gone up even higher. So I suspect that this debt will be totally wiped out by the end of the year. And you might be wondering why I'm talking about the gold prices when it's Fortuna Silver Mines. Isn't it the silver prices that matter? No. The truth is that this used to be a silver company, but now the vast majority of its revenue comes from gold. And its one decent-sized silver mine is set to close at the end of 2024. And after that mine in Mexico closes down, the company will be producing virtually no silver at all. Just a small amount from their little mine in Peru. And now let's analyze how much cash the company might make from operations in 2024. The company's 2024 guidance is between 457,000 ounces to 497,000 ounces of gold, but this is gold equivalent. So we just put it into gold equivalent to make it easier to understand instead of having gold and then silver and lead and zinc, but the vast majority of this comes from gold. And their guidance for all-in sustaining costs, what it costs them to produce an ounce of gold all in, is on the low end, $1,485 an ounce, and on the high end, $1,640 an ounce. Based on a closure of their Oaxaca mine in 2024, well then this number will likely be about 80,000 ounces lower in 2025. However, when it comes to their costs, in Argentina, they're spending a lot of money expanding their leach pad there. So this number should be dropping by about $80 because their numbers for their Lindero mine are affected by about $400 extra per ounce because they decided to do this big capital project all in 2024. And that's going to be done in 2025, which should bring the company-wide all-in sustaining costs down about $80 per ounce based on no longer having that expansion project at Lindero in Argentina. Now, at the same time in 2025, there will probably be some inflationary pressures pushing this up. But even with those inflationary pressures, when you take away that $80 per ounce, I suspect that all-in sustaining costs will be lower in 2025, but as will production in all likelihood. And now, using that company's guidance, let's take a look at what the company's cash from operations might look like in 2024 with several different gold price environments. First, I'm going to do gold 15% lower than where it is today at $1,940 an ounce. And then I'm going to do it at today's gold price, and then at gold 10% higher than where it is today. So here we have $1,940 per ounce of gold. And then we have in this column, production of 457,000 ounces. And in this column, production of 497,000 ounces, which is the low end and high end of guidance for production. And then over here, we have the all-in sustaining cost. So on the top here, we have the lowest all-in sustaining cost, and at the bottom, the highest all-in sustaining cost. So the higher your costs are, the less money you're going to make. But keep in mind that if we come in at the low end of production, we're probably going to come in at the high end of cost. And if we come in at the high end of production, we're probably going to come in at the low end of cost, because as you produce more and more ounces, your fixed cost per unit are reduced, which tends to lower your all-in sustaining costs. So at $1,940 per ounce, we're looking at cash from operations of about $137 million on the low end, or $226 million on the high end. And now, what might the cash from operations look like at today's gold price? Well, on the low end of guidance, we're probably looking at about $292 million. Midpoint cost and midpoint guidance at today's gold price is about $342 million. And at the high end of guidance, we're probably looking at about $395 million. And then if we increase the gold price 10%, we're looking at somewhere between $393 million and $504 million. So based on these numbers and some other factors affecting the company, let's go try to figure out a fair valuation and a fair stock price. And before looking at potential valuations, I think we need to look at the good things and the bad things about this company to try to determine what kind of multiplier they should get. So first of all, you have the proven and probable, measured and indicated reserves and resources. So this is excluding inferred resources, but how many ounces of gold do they have in the higher confidence categories? In gold equivalent terms, that's 4.4 million ounces, and assuming an average production of 450,000 ounces a year, we're looking at 9.8 years of reserves and resources remaining, which isn't great, but it isn't bad either. I would consider this thing pretty neutral. And now for the not so good things, or some of the risks that the company faces. 2 mines are nearing the end of life, so you either have to just accept a lower production level or replace those ounces somehow through growth projects. And they operate in mostly risky jurisdictions. The all-in sustaining costs are higher than average. They have high G&A. I really don't like how high the G&A is. So I'm going to punish them for that in my multiplier. And then you have decreasing production in 2025, and the market doesn't like to see decreasing production. But as for the pros of the company, the all-in sustaining costs are probably going to be decreasing in 2025. You have that diversification of 5 different mines, and maybe they'll be able to extend the Oaxaca mine a little bit longer. Maybe they'll find some more ounces or be able to convert more from resources to reserves. We'll see. The higher metals prices is going to help that. So if the metals prices continue to stay higher, they're going to be more likely to be able to continue operating that mine past 2024. And then the exploration upside and potential future expansion at Séguéla. I think this is one of the biggest pros of the company. They're going to find a lot of ounces there. And then you have a potential growth project that they already own in the form of Diamba Sud in Senegal. Good project. They're spending a lot of money on exploration this year, so it'll be interesting to see what kind of results they come up with there after spending $10 million exploring there. And you have a proven management team. They have lots of mine building experience, great capital allocators, and they've been able to grow this from a very small company to a respectable mid-tier producer. And they've delivered absolutely outstanding results in Africa at their Séguéla mines and their Yaramoko mines. So based on their reserves and resources and these risks and the pros, I'm going to be giving them a 5 times cash flow multiplier when valuing the company. Okay, so don't let your eyes glaze over here, but this is going to be our formulation for the stock price. Don't worry, I'm going to walk you through this. I know it looks complicated with all these variables and numbers and stuff, but it's really not that complicated. You just plug in the numbers and you get the final result pretty easily. Our formula to determine the stock price is going to be our cash from operations, which we went over previously in this video, and you can plug in a different number there based on what the production is going to be, based on what the all-in sustaining costs are going to be, and also based on what the gold price is going to be. And then you subtract from that your net interest expense, which I'm going to put at $4 million. That's my best guess of what the company is going to pay in interest this year, minus what it's going to receive in interest. And then from that, we're subtracting general administrative expenses. And in 2023, that was $64.1 million. And then we're taking that number, cash from operations, minus net interest expense, minus G&A, and we're multiplying that times 5. And then after we get that number, we're adding the current cash on hand, which is $128 million, and we're subtracting the current amount of debt, which is $186 million. And then that's going to be the company valuation. And then to get the share price, we're going to divide this number by the number of shares outstanding, which is currently 306.6 million. And now I'll walk you through this one time. So let's say in an example, we have cash from operations of $447 million. Well, then we subtract $4 million for the net interest. We subtract $64.1 million for the general and administrative expenses. And then we're left with $378.9 million. We multiply that times 5, and then we take that number, we add our cash of $128 million, and then we subtract our debt of $186 million for a total of $1.84 billion. So that's the company valuation. And then from that number, we divide it by the number of shares outstanding, which is 306.6 million, for a share price of $6 US. So this is the calculation I'm going to be doing for every single number you see coming up next. And now for my verdict on the company. First, the risk level. 1 being the least risky, 10 being the most risky. I like that they're diversified across 5 mines. However, they get negative there because 2 of their mines are nearing the end of their life. But I like the management team. I dislike the high G&A. But part of the risk when it comes to investing is at what price are you buying the stock? And right now it's at $4.51 per share. And if we come in at today's gold price, at the mid-range of guidance, I think we're looking at a share price of about $4.27. So I would give the risk level somewhere between a 6 and a 7, considering those things I just mentioned, plus they have some debt. However, because the stock price is a bit too high right now for my comfort, I'm going to bump the risk level up to a 7.5. If it was at a share price that I would consider a more fair valuation, the risk level would be about a 6.5. But if it was at a really low share price, well, the risk level could be much lower than that. But at this share price, 7.5. And my target price is going to be $4.27 because that's today's gold price at the mid-range of guidance. Now, if you look at these potential stock prices here, as low as 93 cents, as high as $6.91, depending on the company's performance and depending on the average gold price, well, this looks really low at this end, at 93 cents. Now, if the gold price got down to $1,940 and we came in at the low end of guidance, could the stock price be here? Yeah, it certainly could. Would I expect it to be? Probably not. I think I would have to adjust that formula a little bit to account for potential upside optionality should we see higher gold prices in the future. But overall, I think this gives you a pretty good idea of what we could see the stock price at moving forward. And for my verdict between sell, hold, buy, and strong buy, because my target price is below the current stock price of $4.51, I cannot give this a buy or a strong buy. However, I'm also not going to give it a sell because the company is generating a lot of cash right now and the market is highly valuing cash generation. And also, this management team has built this company up from being just a little tiny company to being what it is today. And I suspect that this management team is going to intelligently reinvest their earnings to grow this business even more. So I suspect they'll be producing more ounces a few years from now than they are today. So my verdict is going to be a hold. Overall, I think there's better risk-reward plays out there. In fact, I think there's much better risk-reward opportunities. If you would like to see one of those, go check out my video on B2 Gold. I'll link to that right here, and I think that's an incredible risk-reward opportunity in the gold space.